Right now, the gray market premium for the ESDS Software Solution IPO is sitting at a staggering 81. This document section shows the exact bid and issue period dates, alongside the key registrar contact details you'll need if allotment issues arise. For retail investors, the minimum application is set at one lot of 34 shares. That brings the precise upfront capital requirement to 14,586 rupees. The stock is then expected to list on both the BSE and NSE on September 4th. While a 14,000 rupee entry point is standard for a Mainboard IPO, paying up for an 81% premium demands a rigorous look under the hood to see if the company actually justifies the hype. Unlike many specialized tech firms in the Indian market, ESDS functions as a comprehensive end-to-end IT infrastructure provider. This infographic shows their operation broken down into three core segments: infrastructure as a service, managed services, and software as a service. Starting with their infrastructure, they manage 5 physical Tier 3 data centers distributed across Nashik, Navi Mumbai, Bengaluru, Mohali, and Noida. Maintaining physical facilities of that scale requires immense, continuous capital expenditure, especially when competing directly against global hyperscalers like AWS and Google Cloud. Moving over to the software as a service pillar, they have developed their own proprietary AI platform called Swaraj Cloud. Strict domestic data sovereignty laws and localized AI compliance requirements are actively driving government and corporate demand for the Swaraj platform right now. Because they own the physical racks, manage the data, and provide the software interface, ESDS captures revenue at every stage of a client's cloud journey, setting them apart from pure single-service colocation providers. Looking at their financials, top-line revenue has scaled rapidly, jumping from 286 crore rupees in fiscal 2024 to 472 crore rupees in fiscal 2026. This chart shows their profit after tax, and the growth here is aggressive. By the end of 2026, profits reached 120.8 crores, nearly 9 times higher than their 13.6 crore profit just 2 years prior. Layering on their EBITDA margin reveals a 49.6% rate of operational efficiency. That high margin indicates they are generating massive actual cash from their operations, rather than simply inflating top-line sales figures. They are also deploying that capital well, with a return on net worth sitting at a highly respectable 25.12. Monitoring QIB participation on days 2 and 3 serves as your ultimate litmus test to see if deep-pocketed institutions actually agree with the high gray market valuation. Retail investors are allocated a 35% quota for this offering. While a 35% bucket offers better odds than a typical SME IPO, the 81% expected premium virtually guarantees historic oversubscription, turning retail allotment into a strict lottery. Now we have to look past the profit charts and check the specific risk factors buried inside the prospectus. The company carries a severe client concentration risk, with roughly 30% of ESDS's revenue relying directly on government entities and projects. This heavy reliance makes their cash flow highly vulnerable to bureaucratic delays, sudden budgetary cuts, and shifts in political administrations. The most critical financial drag on the company is their material subsidiary located in the UAE, ESDS Cloud FC LLC. This specific foreign subsidiary has posted continuous, sustained losses over multiple fiscal years, eating away at the parent company's consolidated profits. The draft prospectus also discloses outstanding material litigation against the promoters, involving an aggregate amount of 184.80 million rupees. Behind the explosive headline profits and the strong AI narrative, long-term investors will have to absorb these significant international operational drains and domestic regulatory vulnerabilities. So we have to match the data to the correct scenario and answer exactly who this IPO is built for. For investors strictly chasing a quick flip, that 81% premium provides a massive safety buffer against normal listing day volatility. For short-term players, this is a strong apply for the listing pop. For long-term tech accumulators, you have to weigh the superb 49.6% EBITDA margin against the ongoing cash drain from their UAE subsidiary. This graphic categorizes the final verdict. For long-term holders, it is an apply with caution. Holding this stock requires active quarterly monitoring of their government contract renewals and subsidiary cash flows. Ultimately, deploying 14,586 rupees here is a highly favorable risk-to-reward move, as long as you firmly decide your exit strategy before the opening bell rings.